a latte sells for around $5. The coffee inside it, the actual roasted beans, ground and pulled into espresso, usually costs somewhere between 30 and 60 cents. Depending on what you're buying and how much of it. Add the milk, the cup, the lid, the sleeve, the pump of syrup. And you're still typically looking at ingredient costs somewhere in the range of 20 to 25% of the menu price. Which means every time someone hands over $5, roughly 4 of those dollars are, in accounting terms, gross profit. That is a spectacular margin. Better than most restaurants. Better than most retail. It's the number that has convinced an enormous number of otherwise sensible people to sign a lease, buy an espresso machine, and open a cafe. And it is almost completely irrelevant to whether that cafe survives. Not because the number is wrong, it isn't. But because it's answering a question that doesn't determine the outcome. The margin on a single cup tells you what happens after a customer walks in. It tells you nothing about the far more expensive problem, getting them to walk in at the right time of day, in sufficient numbers. In a specific building you're contractually obligated to pay for whether they show up or not. That's the actual business. And once you see it that way, almost everything strange about coffee shops starts making sense. Let's start with the number that never appears in the fantasy version. Before a single cup gets sold, someone has to build the place. For an independent cafe, the range is wide enough to be almost useless as a single figure, a modest build-out in a cheap market with a used espresso machine and an existing kitchen might come in under $100,000. A ground-up build in an expensive city, with plumbing, electrical, a hood if you're cooking, millwork, permits, and a new 3-group espresso machine that alone can run $15,000 to $25,000. Can easily pass $300,000. Landlords sometimes contribute through a tenant improvement allowance, which is money toward the build-out, usually amortized back into your rent. It helps. It doesn't change the fundamental fact. Here's what matters about that money: almost none of it is recoverable. A used espresso machine holds some value. Tile does not. Plumbing does not. The custom counter you designed does not. If the business fails, you don't sell the assets and walk away with most of your investment. You walk away with a fraction. And the landlord keeps a nicely renovated space to lease to the next optimist. Which brings us to the document that quietly decides the fate of the entire enterprise. The lease is not a bill. It's a bet with a fixed payout schedule. A typical commercial retail lease for a cafe runs 5 years, sometimes with an option to extend. Rent is due monthly regardless of sales, on top of base rent. Most leases add what are commonly called CAM charges, common area maintenance, which cover the landlord's costs for the shared parts of the property, plus property taxes and insurance pass through to you. These often escalate annually, frequently around 2 to 4%, sometimes tied to inflation. And in the vast majority of cases, a first-time independent operator will be asked for a personal guarantee. That means if the business fails, the corporate entity's collapse does not end the obligation. The owner personally still owes the remaining rent. Not the business. The person. Sit with that for a second, because it's the single most under-discussed fact in this entire industry. The moment that signature goes down, the owner has committed to paying for a specific set of square feet for years, and has done so before knowing whether anyone will buy anything. So the real question was never, what's the margin on a latte? It's, how many lattes must move through this specific room to cover a cost that doesn't care whether anyone shows up? And the answer to that depends on something most people never think about at all. Coffee is not sold evenly across the day. It's sold in a spike. The pattern is consistent enough across the industry to be treated as a planning assumption. A large share of daily sales, often reported as the majority, happens before 11 in the morning, with the sharpest concentration in a rush that might last 90 minutes. There's usually a smaller afternoon bump, then a long, quiet tail. This is the hinge on which the whole business turns, so let's be precise about why. Your rent is charged by the month. Your equipment is paid for. Your baristas are scheduled in shifts. All of that is fixed, or close to it. But your revenue arrives in a burst. Which means the cafe's capacity to earn is not determined by its size, its quality, or its hours. It's determined by how many transactions it can physically complete during the window when people actually want coffee. Baristas and consultants have a word for this: throughput. It means the number of orders you can take, make, and hand off per unit of time. And it is the real constraint on a coffee business. In the same way that seats per hour is the real constraint on a restaurant and occupancy is the real constraint on a hotel. Consider what that implies. If your morning rush is 100 minutes long and your line moves at 3 customers per minute, your absolute ceiling is around 300 morning transactions. Not however many customers want coffee. 300. If 400 people would have bought something, 100 of them looked at your queue, calculated how late they'd be, and walked to the place across the street. You didn't lose those sales on price or taste. You lost them on geometry, the layout of your counter, the position of your register, the number of steps between the espresso machine and the milk fridge. This is why serious operators obsess over things that look absurd from the outside, whether the pastry case is before or after the register, whether the cups are stacked within arm's reach, whether the second grinder eliminates a 2-second pause per drink. 2 seconds per drink, across 300 drinks, is 10 minutes of recovered peak. 10 minutes of peak is 30 more customers. 30 more customers a day, at $5, is over $50,000 a year in revenue that appears from nowhere except better choreography. But throughput is only half the equation. Because you can be genuinely busy and still lose money, and the reason involves the most expensive thing in the shop. Look around a cafe at 2 in the afternoon. There are people at tables. Laptops open, headphones on, a single cup at their elbow that they bought 2 hours ago. The room looks alive. The owner is losing money in that room, and here's the arithmetic. That table occupies square footage the owner is renting by the month. If rent, taxes, and CAM come to, say, $6,000 a month on a 1,000 square foot shop, every square foot costs $6 a month. A 2-person table with its chairs and its share of walking room might consume 25 square feet. $150 a month. Or roughly $5 a day, of pure fixed cost. A customer who occupies it for 3 hours on a single $5 drink has consumed most of that seat's daily rent while generating about $1 of gross profit per hour, before any labor, power, or the electricity for the Wi-Fi they're using. The seat is not a perk. It is inventory. Expensive, perishable inventory that the shop gives away for free and cannot repossess. Which produces one of the strangest inversions in the business. The customer who is best for the cafe's atmosphere. The one who makes it look warm and busy and worth walking into, is frequently one of the least profitable people in the building. And the very best customer, the highest margin, lowest cost, fastest turning customer of all, is the one who never sits down, who orders on a phone, grabs a cup from a shelf, and leaves, or who never even opens the door. The industry figured this out, and its response reshaped what coffee shops physically look like. The drive-thru is not a convenience feature. It's a structural fix to the throughput and seat problem. A drive-thru lane lets a shop serve a queue of customers who consume 0 seating, 0 table service, 0 cleaning labor, and who, critically, can be served during peak in parallel with the indoor line. It converts a fixed capacity room into something closer to an assembly line. Mobile ordering does something similar from the other direction. It moves the ordering step out of the store entirely. So the register stops being the bottleneck. Starbucks has reported for years that drive-thru and mobile orders make up the large majority of its U.S. transactions. That is not a story about coffee preferences. It's a story about a company systematically removing every part of the experience that consumed expensive minutes and expensive floor space. So if the ingredients are cheap, the seats are costly. And throughput is king. What's actually eating the money on a healthy cafe's income statement? Not the coffee. Labor. The rough industry benchmarks that operators and lenders use tend to look something like this: cost of goods around 25 to 30% of sales, labor around 30 to 35%, occupancy, rent plus CAM. Ideally under 10%. Though in expensive cities it frequently isn't, then utilities, insurance, repairs, payment processing fees, marketing, waste, breakage. What's left over as net profit for a well-run independent is typically single digits to the low teens. As a percentage of sales. Treat these as planning heuristics rather than laws. They vary enormously by market, format, and whether the owner works the counter. That last variable deserves attention, because it hides inside a lot of profitable cafes. If the owner works 45 hours a week behind the bar and doesn't pay themselves a market wage, the labor line looks artificially healthy. The business appears to earn, say, $70,000 a year. But if replacing the owner with a paid manager would cost $60,000, then the business as a business earned $10,000, and the owner earned a job. Those are very different things, and the distinction becomes brutally clear the moment that owner gets sick, burns out, or tries to sell. Notice what hasn't been the villain in any of this. The coffee. Which is genuinely counterintuitive, given how much coverage coffee prices get over the past couple of years. Arabica futures, the benchmark price for the higher grade coffee that most specialty shops use, climbed to record nominal highs. Driven largely by drought and adverse weather in Brazil and supply problems in other major producing regions. Headlines framed this as an existential threat to cafes. For a cafe selling espresso drinks, it mostly wasn't. If the beans in a latte cost 40 cents and the green coffee price doubles, the roasted cost doesn't double. The roaster's own costs, labor, packaging, and margin dilute the move. But even in the worst case, you're adding perhaps 20 to 40 cents to a $5 drink. Painful, absolutely, on thin net margins. Not fatal. But follow the same shock into a different business and it becomes lethal. A roaster selling 12-ounce retail bags is selling a product where green coffee is a huge share of cost, and where consumers notice a $2 price increase immediately. A diner selling bottomless drip coffee at $1.50, where the beans are a much larger fraction of a much smaller price, gets squeezed hard. The same commodity shock, the same percentage move, produces wildly different damage depending on how much of the final price is coffee. This is the pattern worth internalizing, in a business with cheap inputs and expensive space. Input shocks are survivable and location mistakes are not. Which is exactly what the world's largest coffee company had to learn in public. By the middle of the 2000s, Starbucks was in one of the most impressive expansion runs in retail history, opening thousands of stores and reaching well over 10,000 locations in the United States. The growth story was straightforward: demand for the Starbucks experience was enormous, so build more Starbucks. Then, in February 2007, Howard Schultz, who had stepped back from the CEO role, wrote an internal memo to the leadership team. It leaked almost immediately. Its subject was what he called the commoditization of the Starbucks experience. He argued that in the pursuit of efficiency and scale, the company had stripped out the things that made a store feel like a destination: the automatic espresso machines had removed the theater of the barista. Flavor-locked packaging had removed the smell of coffee from the room. Standardized store designs had removed the sense of place. The company had, in his framing, traded soul for throughput. That memo is usually remembered as a story about brand and romance. But the harder problem underneath it was arithmetic, and it surfaced when the economy turned. Schultz returned as CEO in January 2008. That February, Starbucks closed roughly 7,100 U.S. Stores simultaneously for a few hours to retrain baristas on espresso, an extraordinary, deliberately visible gesture. Then, in July 2008, came the number that told the real story. The company announced it would close about 600 underperforming U.S. company-operated stores, a figure that grew to roughly 900 as the plan expanded. Thousands of jobs went with them. Here's the part that connects to everything above. A large share of those closures were stores opened relatively recently, and the company was explicit that many were underperforming in part because of cannibalization. New Starbucks locations had been placed close enough to existing Starbucks locations that they split the same commuter flow between them. Trace the chain, because this is the exact mechanism that kills independents too, just at a smaller scale. A store's revenue depends on capturing a share of a fixed stream of people passing a specific point at a specific time of morning. That stream does not grow because you opened a second door. So when a new location opens 2 blocks away, the morning peak gets divided. Store A's transactions drop, say, 15%. Its rent does not drop. Its manager's salary does not drop. Its equipment lease does not drop. Because the cost structure is dominated by fixed commitments. A 15% revenue decline doesn't cut profit by 15%, it can erase profit entirely. Because the sales that vanished were the ones sitting above the break-even line, where nearly every dollar was falling straight to the bottom. Then the recession arrived and shrank the stream itself. Discretionary $5 purchases are among the first things households trim. Now the same fixed-cost store was fighting a smaller flow of customers and splitting it with a sibling. That's the domino sequence: fixed occupancy costs, plus revenue concentrated in a narrow window, plus a competitor drawing from the same window, plus a demand contraction. Any one is manageable. Together they don't subtract, they compound. And a company with enormous scale, a beloved brand, and world-class real estate analytics still had to shutter hundreds of stores to escape it. Now shrink the scenario down and remove every advantage. The independent owner has no portfolio to average across. They have one lease, one location, and a personal guarantee. When a competitor opens near their corner and takes a slice of the morning peak, the response options are limited and each one is a trap. Cut labor to protect margin. And the peak slows, fewer transactions in the only window that generates money, which deepens the very problem being addressed. Raise prices, and accelerate defection to the new place. Extend hours into the dead afternoon and evening. And add labor and utility cost to hours that were never profitable to begin with. And closing isn't an exit. The remaining rent on the lease is still owed, personally. The build-out can't be sold for anything close to its cost. So the owner often keeps operating a business they know is losing money. Because operating at a loss can genuinely be cheaper than the alternative of walking away. This is why so many failing cafes don't shut suddenly. They persist, quietly, for a year or two. Funded by the owner's savings and the arithmetic of a personal guarantee. You've probably heard a statistic claiming that most coffee shops fail in the first year. The figure is often quoted as high as 95%. There's no credible source behind that number, and it should be treated as folklore. What we do have is broad U.S. Bureau of Labor Statistics data on new establishments across all industries. Roughly a fifth don't survive 2 years. And around half are gone by year 5. Food service tends to sit at the harsher end of that distribution. The honest summary is that a cafe is a meaningfully risky business. Not a near certain loss, and the specific risks are the ones we've been describing, not bad luck. So how do the ones that work? Mostly by refusing to be only a coffee shop. Look closely at durable independence and you'll usually find revenue that isn't dependent on the morning peak at all. Wholesale accounts, selling beans to restaurants and offices, generate volume with no seating cost and no counter time. Retail bags and subscriptions turn a customer's home into a second point of sale. Catering and office delivery monetize the flat part of the day. Food, where a pastry program or a real kitchen adds items with different margins and, more importantly, raises the average ticket, so the same throughput yields more revenue per transaction. Some shops make more from a well-run food menu than from espresso. And a second location, once overhead is shared, one roasting setup, one manager layer, one bulk purchasing relationship, can be more profitable than the first was. Which is why successful independents so often jump from 1 to 3 stores rather than staying at one. Notice the common thread. Every one of those strategies is a way of escaping the tyranny of a fixed room during a narrow window. They're all attempts to earn money from something other than butts in seats between 7 and 10 in the morning. So let's answer the question honestly, in 4 versions. The best case, a well-located, well-designed shop with strong throughput, a real food program, and wholesale on the side, run by an owner who understands the numbers. It can clear low to mid 6 figures in annual sales as a small shop, or well over $1 million in a strong urban location, with net margins that might reach the mid-teens. And it becomes a genuine saleable asset worth some multiple of its earnings precisely because it can operate without the founder standing at the bar. The realistic success, the shop works, it's beloved. It clears enough to pay the owner a decent living and slowly retire the build-out debt. It is a good job with real autonomy and modest wealth creation. Most happy cafe owners live here. And most of them will tell you the money was never the reason. The realistic disappointment, the shop is busy, well-liked, and generates just enough to cover costs and pay the owner less than they'd earn as a salaried employee somewhere else. It survives on the owner's unpriced labor. It cannot be sold, because there's nothing to sell but a lease and used equipment. The failure, a competitor opens nearby, or the anchor office building empties. Or rent escalates on schedule while sales don't, and the fixed cost structure does what fixed cost structures do. The build-out is lost, the personal guarantee activates, and the owner spends years paying for a room they no longer stand in. The gap between those outcomes has very little to do with the quality of the coffee. It has almost everything to do with the lease that was signed before the first bag of beans was ordered. Which returns us to the $5 latte and its 60 cents of coffee. That margin is real. It's also a lure. High gross margin on a simple product with low technical barriers is precisely the condition that attracts a flood of undercapitalized entrants, which is why cafes cluster, why they cannibalize each other, and why the margin that looks like an opportunity is also the mechanism that keeps the market permanently crowded. The $4 of gross profit on that cup were never yours to keep. They were the pool from which rent, labor, and the next competitor's arrival would all be paid. The product being sold isn't coffee. Coffee is the toll. What's being sold is 30 seconds of convenience at a specific point on someone's commute, and the business is a wager that you can convert a fixed, expensive, non-negotiable number of square feet into enough 3-minute transactions before 11 in the morning to cover a bill that arrives whether the door opens or not. Own a coffee shop, and you don't really own a coffee business. You own a lease, and a very short window each morning in which to justify it.